So I'm excited you guys could join us today. We have an all-star panel of great speakers. I think 2025 has been kind of a watershed year for institutions getting into tokenization, getting into on-chain assets, and eventually getting into turning these static assets into very liquid collateral, whether that's in trading or using it as collateral or doing other on-chain DeFi primitives with them. We've seen an evolution of market structure really take off and start to form this year. And so I'm very excited to have a great panel coming from different perspectives. We have folks that are working with allocators, and we have folks that are working with some of the largest asset issuers and asset managers in the world. Very curious to hear their perspectives about how people are thinking about scaling RWAs on chain. So I'll give it to the speakers to do a quick 30-second introduction on what they're building.
Thanks, Avi. Hi, my name is Thomas. I'm the CEO of Function. Today, we are a Bitcoin yield marketplace, but we're also starting to look at RWAs.
Hey guys, I'm Thomas Cowan. I lead tokenization at Galaxy Digital, which is a crypto-focused merchant bank.
Hey everybody, my name is Graham. I'm head of ecosystem at Securitize. We are the market leader in tokenization with over $4.5 billion in issuances to date.
Hey, my name is Ryan Zega. I lead the financial service business development efforts at Aptos. So we're a layer one blockchain focused on institutional use cases as well as other potential areas.
Awesome. So I really want this session to be very interactive. So feel free to jump in if there are other, spicy takes or you disagree with something. Like I want this to be an open forum. So my first question is that there are a lot of adverse selection in terms of issuers coming on chain. And so when you're thinking about bringing assets on chain, what are you guys looking for? How are you guys diligencing them? What exactly is a pristine asset and how do you back them, right? How are you guys are throwing your name, Securitize, behind these assets. So curious, Graham, to hear your thoughts around this.
Yeah, so I think it's a great question. I think overall, what we need to do is think more about the end user and who's actually going to be purchasing these assets, right? So if you think about the typical DeFi end user, this is somebody who probably wants to earn a lot of yield. They want assets that are highly liquid. And so those are really the two things that we like when we're trying to figure out what to tokenize. But I think it goes beyond that, right? I think there's tons of opportunities to tokenize ETFs, for example, in regions in the world like LATAM or across APAC, right, where it might be very difficult for folks to get access to these types of assets. So I think it's, for us, at least at Securitize, we have a ton of these asset managers that we're working with, but it's about working backwards and figuring out how can we help open new customer segments for them.
I think one thing I would jump in and add on as well is I think in the previous cycle, a lot of the time people looked at tokenization as a way to unlock liquidity, when in reality, we've seen the two most successful on-chain assets have been stablecoins and money market funds, which, the underlying of fiat and money market funds off-chain are the two most liquid assets, off-chain. And so we're definitely seeing that progress as we get more and more interested. But you're right, the two things in the conversations for us that we have are yield and liquidity. And those two things are still king on-chain.
I would also add, DeFi typically eats the long tail first. So the liquidity is still a problem, but I would not be surprised if while the West is getting their act together of, what does issuing natively looks like, crypto does not have that long of a, attention span, right? So I would not be surprised if people start doing emerging market tokenization of those longer tail assets that are traditionally higher yield, higher risk, right? But people in DeFi love yield. So to Thomas's point, that might be what arrives first until the industry gets a little bit more saturated and has the rails for some of the more mature blue chip products to move in.
Yeah, no, and I kind of echo the same points, right? Scalability, usability, and then quality of sponsor are kind of three things that are needed from a layer one perspective. And then we also try to align them with different goals, right? Money movement, RWAs, data transformation are kind of three of our pillars. And then depending on the layer one or layer two, there may be differing goals, but yeah.
Yeah, so liquidity, I think I've heard a couple times. Thomas, I think both Thomases, you guys sit from the seat of an allocator perspective. So Thomas, you represent a very, very large pool of Bitcoin LPs, right? So they're providing a lot of TVL to your protocol. Thomas, also you guys sit on a huge balance sheet at Galaxy, and you guys invest those on a proprietary scale. What are you guys? I guess my question is that what are allocators really looking for when they're allocating to tokenized RWAs on chain? Like, what are the mechanics? What are some of the features? What is the risk profile?
So I could talk about more specifically from the perspective of BTC, because those are most my LPs, and then that could probably be extended or Thomas's inputs onto general RWA issuers. From the BTC perspective, I don't think it's that different. At the core, they care about principal protection, so security of the underlying asset. In this case, it is BTC. Where is it custodied? Who has access to it in case of a liquidation event? These are things that are the number one thing that they want to think about, because right now, if you look at pure DeFi for DeFi's sake, BTC yield, if it's less than 1%, it's probably not worth whatever ounce of smart contract risk there is. Just simply not, right? The strategies that we employ, we've got about 1.5 billion in TVL, and it's across 5 or 6 different strategies, generally yielding between 1.5% to 5%. These are still very boring strategies. So the first one is security of the underlying BTC, and then they want to underwrite the strategy itself. The strategy itself, if you present it in such a way where the risks are understood and it's something they can underwrite, like credit risk, it's a lot easier for them to understand than asking them to underwrite a net new protocol.
So where are your LPs' monies now today? Like, what are they deployed into?
Yeah, a lot of it are. So we're just a marketplace. We don't actually run the strategies ourselves. Those are effectively being run and curated by the likes of, we have 2 today, Centaura and Keon, and we're, of course, usual suspects are there, Gauntlet, MEV, etc. The strategies that seem to be most popular are stablecoin strategies, kind of vanilla, but they're effectively taking BTC, FBTC as collateral on Aave, borrowing a stablecoin, USDC, USDT, RLUSD, or even PYUSD, and then depositing it somewhere else, effectively a carry trade. So very simple, but these things do have scale, and you can take in thousands of BTC.
Yeah, I guess when I think about where people are allocating different amounts of TVL, I kind of break it into 2 buckets, right? Most of it is the crypto folks. The exposure that they want off-chain are, safe, to your point, reliable, well-known names. You think of, the BlackRocks of the world or the Apollos, a cred fund of the world that the Securitize did. And then on the other side, you see the traditional financial players are coming to this space because they simply can't get the Bitcoin exposure that they might want beyond an ETF. And so that's why we're seeing increased demand and interest from our institutional counterparties that want some kind of Bitcoin, but might be a structured product that's Bitcoin denominated, or a structured product that gives you exposure to a few of the different key crypto assets. So it just kind of depends. But what's important is over the past 18 months, we've seen these 2 worlds come together in a way that we haven't seen in previous cycles. And what I'm most excited about is these worlds are coming together independently of the price of Bitcoin. So to me, so that if we end up going into winter, if prices end up going down, I think from a tokenization perspective, that has already kind of taken off to a point where that integration is almost inevitable, which I think we're very excited from both sides of where we sit.
Awesome. Graham, and so I know you guys have a ton of investors on board to the Securitize platform. What gets them excited today? Where are investors trying to put their money?
Yeah, I would say at Securitize, we're uniquely juxtaposed in between the asset managers and then the crypto distribution rails, right? And so I'm constantly having conversations with folks on both ends of that spectrum to figure out how do we connect the two. That's kind of how I view my role, is being that glue, right? And so what gets them excited? I mean, it totally varies. I mean, we've seen a lot of success with our BlackRock Biddle Fund, our Treasury Bill Fund. It's currently the largest tokenized issuance, around $2.5 billion into that specific fund. It's the backing asset for several stablecoins. So with some of the stablecoin issuers, that's something that gets them very excited, right? Now, when it comes to funds like our Apollo Fund or Hamilton Lane Fund, for example, the folks that want to use or get access to these funds, they want strategies built around these funds, right? So a lot of our work today is focused on working alongside protocols. You may have seen we just integrated with Aave Horizon. We were actually instrumental in helping put that protocol together to accept permissioned assets on the collateral side. And so this is coming as a direct result of conversations with these issuers and then ultimately with the purchasers of these assets as well.
So you guys are working directly with these issuers. You are building feeder funds into their products. Or in the case of Thomas's case, you guys have done a really interesting project with Superstate, or they're actually sitting on the cap table, right? They have a transfer agent, so they have legal rights to Galaxy stock. And so I think, something that we've also been seeing is the discrepancy between, you have synthetic products in the market that are almost like IOUs, so no real ownership of the underlying, and then you have, the other version of that product, which is you're actually sitting on those cap tables. Do you guys think that it's important? Do you guys care? Is it like, from like the asset issuer perspective, if it brings you TVL, how do you guys think about that?
So I'll jump in first, and then please follow up. From the Galaxy perspective, when we thought about tokenizing our stock, we really wanted to make sure that the stock and the token were identical, right? So in my Phantom wallet on my phone, the token that I hold is Galaxy Class A common stock. There's no SPV. It's directly, and the way we did that was by working with Superstate, which, full disclosure, is a portfolio company of ours. But what they did was we hired them as a sub TA, and so when you DRS your shares from your brokerage account, it goes all the way down, and then they tokenize that. And so that's kind of the way we see it happening more broadly. It's a very, very early, and we're still in early stages there. But longer term, we think that direct connection is something that we see the market kind of adapting to in the longer term.
I think we uniquely represent all parts of the stack of the system, right? So except for an asset issuer. So let's assume that one of the audience members is an asset issuer, right? The first step is through Securitize. They conduct the SPVs and then also do the securitization of it. And then it goes to the distribution side, right? And that role could be played by Function from the perspective of marketplace, or Galaxy as a market maker. And then there's the underlying infrastructure, which is Aptos as well as Plume, right? So like the 4 or 5 of us all sit as different layers of this stack. And I think what's missing is, I don't know, from my perspective, is a capital efficiency issue with a lot of these RWAs because they have long redemption periods. We come from a world where it's just BTC, so the redemption is actually fairly quickly when we're minting and burning BTC. So we think about how do we extend that to RWAs and also make it hyper capital efficient. And I think that could be an unlock to a lot of the longer tail RWAs that DeFi wants access to, but in its current format is inefficient or doesn't make sense to get just given the opportunity cost.
Yeah, and just to kind of jump in, so prior to joining Aptos, I was with a broker-dealer called T0. So there is that regulatory element, right? Like the ideal, and from a layer 1 perspective, right? Ideally, these products can be distributed globally, but in reality, probably can't do that in a native manner, and that's why these synthetics have emerged that aren't perfect products, but they're trying to solve that problem of how do we get this particular regulated product in another form or wrapper out to a global or broader distributed audience. So hopefully there's an alignment one day, right, of regulation and native issuance to allow for both to happen. But obviously there's a lot of consideration with that.
Yeah. So what kind of mechanics should asset issuers be building into their products when they're thinking about, okay, I actually want to make this product scalable on chain? Maybe this is a question for Thomas. Sorry, not this Thomas. At BTC.
Okay.
But if you will only answer, that's great too.
Well, I think about it from the perspective of the LP, the buyer, and what they're looking for. There's a lot of smart contract auditing and just understanding what the asset is, right? Because I'll give you an example. Apollo, very well known here in this audience, average APAC LP, never heard of it, right? And so what they typically look at is like, oh, what's the top line yield? Is there a lockup, right? And is it being done on a DeFi dApp that I trust, or are my friends doing it? It's pretty simple, right? Their thinking process as it is today. So for asset issuers to think about scale, from our perspective, there is a KYC component. Maybe I don't have the best answer here, but I feel like the synthetic market is going to take off because I don't know if I don't believe that crypto has the patience for traditional financial institutions to build the right rails to start issuing natively on chain. I was on a panel earlier where I heard that people are predicting that's 3 to 5 years out. That's just 3 to 5 years too long for DeFi. So I think a lot is going to be happening in the next 6 to 9 months or so.
I think with equities, in many ways, I think we, with equities, are where we were the previous cycles with stablecoins, meaning that we started with Tether, we started with USDC, and now everyone is issuing stablecoins. But most people, if you ask them, okay, do you think 3 years from now we're going to have dozens of stablecoins, Walmart coin, Amazon coin, Facebook coin? No, it'll all come together, and you'll have one or two that will likely dominate the market, and that'll kind of fall away to the back end. So you just know you're holding a dollar. That's likely what's going to happen with equities, where like today you might have all these different SPVs that are filled with Galaxy stock, representing our ownership on chain. That's where we are, over the next 2 or 3 years. But long term, you're going to end up with one type of Galaxy stock. It's just the market's going to coalesce in that way. We still have a long way to go. It'll depend on the chain. It'll depend on the regulation. It'll depend on all kinds of different variables. But long term, it's just the most efficient way to have the market, given liquidity and other considerations you need to take into account.
Yeah, I think also anecdotally, I think other Thomas, to your point, it's Securitize. I mean, it's in our name. We work with securities, right? We're tokenizing securities. And there's sort of a translation gap, I feel like, oftentimes. I mean, I interface with protocols on a daily basis, helping them figure out how best to reconfigure their own architecture to be able to facilitate trading of securities. And just last week, I was working with a protocol team. They're a great protocol team. I won't mention their name, but they pinged me a very normal ask for a DeFi protocol, which is, can you send me test tokens? I want to run some test flows for what this, how this could work. And I go back to my team and I say, can we get some test tokens? They're like, what? You want to test with securities? Like, you can't do that. And so I think it's really important on us to be able to translate some of the differences between, what we're experiencing, on the more traditional finance side of things, and then communicating that to the exchanges that are going to be the ones that are distributing these assets.
Makes a lot of sense. So Securitize, so no, you guys are not moving into this more like synthetic type, more permissionless version. Okay, great. So
Someone's going to do it.
What's that?
Someone's going to do it.
Someone's going to do it, and I think they have done it. We built like Aptos Plume, right? It's a way to get permissionless access to RWAs. We'll kind of see how that works out and pans out in the next year or so as we grow that. But I think, there's been many approaches to kind of growing some of this RWA distribution. So want to go down the line. What is like one thing you guys are excited about for your business in the next year?
It's kind of like what we mentioned earlier, right? So today, if you really think about what we are, we're like the Bitcoin app store. We've effectively tokenized BTC and put it out in the DeFi market and created this curated marketplace where people can get safe, more conservative, balanced, or aggressive yield based off their risk profile. Now, the thought occurred, okay, well, if we did this for BTC, why can't we just do the same for any RWA, right? What we've effectively built is just the infrastructure. You can plug and play any different type of token. So we're starting to look at that and examine how can we play in the RWA space as a marketplace. So I'm pretty excited about that.
One thing that we're excited about at Galaxy is on-chain structured products specifically. I think we've seen the movement of stables and tokenized money market funds, but we just see with structured credit, there's so much margin there and so much inefficiency off-chain that being able to have the underlying pool of debt, for example, be have instant settlement, have that full transparency so that regulators can really see what the underlying is, and then you can create a secondary market when it's fully tokenized, and then finally that unlocks an ability to have much higher collateral as well, because people can see transparently of the quality of the asset that they're issuing a loan against, so they're much more likely to give you a higher LTV. So I know that's a lot, but we really see that as kind of the next unlock over the next year to 18 months, where we see that next asset class coming on chain.
I would say in one word, it's utility for these assets. I don't think there's any shortage of interest in these types of products on chain, but it's building products that people want to buy, and it's working with protocols. And I view it as very much a coordination problem. You have to work with the markets where these assets are traded, the asset issuers, the tokenization platforms, the curators, risk managers, stable coins to provide liquidity. I mean, there's so many moving pieces, and it's like a puzzle that you have to kind of bring together. And so I feel like at Securitize, we're uniquely positioned to be able to do that, to bring that puzzle together. And I anticipate that there'll be a lot of interest in these types of products in the coming years.
Yeah, and my hope is 2026 becomes the sort of year of implementation, right? We've got a lot of POCs, incubated projects, hopefully we can kind of take them over the line. So even at Aptos, right, we're incubating a perp DEX, we're incubating a decentralized file storage solution. We'll be debuting those in 2026. The hope is some of our partners that are doing these POCs will also kind of release that. And that's across the board, whether it's, Aptos or Plume, whatever it may be.
I just want to add that I don't want to, or rather, I want to highlight just how many moving pieces there are in this stack, if you will. There's not like a general taxonomy consensus for what DeFi looks like, right? Unlike TradFi. So I'll give you an example. When we think about going to market, let's just say pick Aptos for example. We have to line up in order. All right, do I have liquidity? So I need a DEX, right? I also need someone to provide liquidity. I need a market maker. I need a lending venue, right? If there's a perp, we'll take that too. And then I need someone to run the strategy. That's 6. Plus the LP 7, plus the wallet that they use 8. So there's like 8, almost around a dozen different players that you got to coordinate in order to get an effort done. And I think as we do more reps, people get familiar with this playbook and people are like, okay, I know exactly how it's done. But up until now, a lot of us have just been trying to piece it all together while we launch. Yeah.
Are you saying that DeFi has counterparties in it?
What's that?
Exactly. It's true, though, especially when we're tokenizing RWAs. It's wild how many counterparties you have to work with because you have to have all the normal on-chain counterparties, and then you have, to your point, everything else on-chain, and it's actually more complex, not simpler. I think long-term, once we're able to kind of move the full set of the financial system on-chain, everything will be faster, better, cheaper. But I think a lot of people at a high level, when they jump in and they realize there's actually more complexity, it's quite counterintuitive.
Makes a lot of sense. I think like building from just a chain perspective, right? Like we are helping protocols like yourself stand up the whole stack, right? And then in traditional finance, you have service providers, you have other counterparties that do this. But I'm sure at Aptos, right, you guys had the same experience. Well, how do we get $100 million of stables on your chain? And that's expensive, right? And so you're almost bootstrapping and kind of trying to get this small pool of on-chain capital to come onto your chain and interact with these RWAs. And so definitely, I think we're all fighting the good fight over here.
The language is also very different, right? How do you explain to someone who's more traditional finance, oh, this is liquidity provisioning, right? Or protocol revenue. They're like, what is that? I understand risk-free rate plus X, right? Like, help me understand it in those terms. So there's a lot of cross-pollination in both worlds of TradFi going into crypto, crypto coming into TradFi.
Well, what is the risk-free rate on-chain? Do we know? I think there's a couple of definitions, right?
Depends on who you ask.
Yeah.
Depends on the chain.
That's great. Okay, awesome. So we have around, we have 7 minutes left. Kind of want to think about, where do you guys see this moving in the next year and also in 2030? I think there's a lot of things happening politically, right? I think with the Genius Act, there's been a lot of interest and a lot of foundations built with stablecoin legislation. That's one thing I think that's been tremendous for this year. But curious, any hot takes, any predictions for the next year and the next 5 years?
I have another viewpoint that I want to add, which is majority of my LPs are Asia-based. So it's a mix of West and East, but primarily it's Asia-based. And if anyone here has ever worked with Asian companies, the one thing they're really, really good at is trying to out-execute you. So from that perspective, I think that by the end of next year, we're going to see a lot of tokenized RWAs, but not in the Western traditional sense of equities. That is a purely, call it American eye of the storm thing that people are looking at. But all the other emerging market credit, maybe emerging market equities, right? Which Asia, by the way, U.S. is 50% of the equity market. The rest of the world is also the other 50%. China's like 20, 30%. So there's a lot to do outside the U.S. So I would not be surprised if a player goes and tries to scoop up the non-U.S. market with regards to longer tail RWA assets, and I think that's going to happen next year.
I'll say one of my goals for 2030 is for us to not have to talk about tokenization because it'll just be, the back end given of, hey, this asset happens to be faster, better, cheaper, and I don't really care whether right now when I send an email, whether it goes over AWS or, Azure, it just happens. And I hope that's where we get. Do I think we'll get there by 2030? Absolutely not. I think it's going to be much longer than we anticipate, at least on this stage. And I think the other thing to note as well is for 2026, I completely agree that that's kind of the long-term One thing I hope and expect to happen is that we'll separate crypto native assets from RWAs even more, so that large institutions, when they come in to get exposure, they really can focus on the fact that, hey, we're gonna just use this new system of Rails, not to upend the financial system, but to upgrade it.
I liked Ryan's point about 2026 being the year of implementation. I agree with that. And also, to steal one of your points as well, I think we oftentimes talk about these like one-click strategies, and that's kind of like, at least for me, I think of that as like Valhalla. Like eventually, maybe we'll get there. I would like to think, I'm an optimist eternally. I would like to think we'll be there by 2030. But the building and the implementation for those strategies that's happening right now. And so I would anticipate that we make a ton of advancements towards some of these over the next year, and then eventually it's going to feel like the TradFi experience that you have today, but with better products.
Yeah, no, I think it all makes sense. And then kind of looking from a U.S. perspective, it would be nice to have a continued focus on advancing legislation, right? Because the White House Digital Asset Report, there's a lot more than just stable coins. So like the evolving role of regulated counterparties, who can do what, like that's something that's going to take years to implement, right? And then take years to actually create legislation around. And then APAC is one of our core markets as well. I spent a lot of time in kind of Hong Kong, Japan, Korea, Singapore, right? There's a high level of enthusiasm regardless of jurisdiction, but then kind of the advancement of regulations is really like country by country. So very bullish on some of these conglomerates kind of getting in the space, starting out with, again, that POC, and then hopefully advancing into other areas. RWA tokenization would be great. And then with regulation, I think there's going to be like a rapid sort of focus on kind of getting up to speed with the U.S. stablecoins, and then hopefully additional products down the line. But big proponent of APAC.
I just want to add, I feel like limitation is the mother of all inventions, and there's a time scarcity here that at least, like, for example, a lot of us are probably seed to Series B stage companies. The lifespan for that is not going to be 5 years till 2030, so that's going to force the market current participants to innovate and come up with novel primitives or products that will fuel the next wave before TradFi moves in. So I think it's going to happen much more quickly. I didn't think DATs last year. I thought DATs were going to start in Q4 of this year, and it happened in a flash within like 7 months, and now it's that narrative is ending. So I think it's going to be a lot sooner than we think.
I know we wouldn't talk about tokenizing DATs, but Thomas did it, so.
There's also this, in my head, there's also this weird loop where a DAT is basically a levered version of the underlying asset, right? Because you're trying to trade a premium to MNAV. What happens if you then further tokenize the DAT and bring it back on chain, and it becomes a little bit of a weird recursive loop? So anyways, just some food for thought.
Well, then you could do a DAT of that loop.
You could do it all on Securitize.
Awesome. Well, I think we're up on time here. Thanks, everyone, for coming by, and thanks for the speakers for your insights, and we'll be around if anyone wants to chat, but thanks so much.
Awesome. Thanks.